Hello and welcome to CMC Markets on Tuesday the 9th of July and the weekly market update, and the buzzword for this week is forward guidance. Yes, forward guidance. If I never hear that word again, it will be too soon. Unfortunately, I think we're going to be hearing an awful lot more of it after last week's events at the Bank of England and the European Central Bank, because the statement that was published after last week's rate decision from the Bank of England could well have significant impact on the pound going forward. And that's really what is going to be at the heart of this particular market update this week. I'm going to have a look at the pound, the key levels there. I'm also going to touch upon, obviously, the non-farm payrolls data on Friday, the better than expected figures out of the US, and the effects that that payrolls data had on US bond markets, particularly the 10-year note, and the break of the 6-year uptrend on the price, though on the yield chart the line just about appears to be remaining intact. So let's start with our old favourite, the cable, dollar sterling as it's better known. Since Thursday we've seen a significant decline in cable from 152 to 148. Now you can debate the whys and the wherefores until you're blue in the face. The very dovish statement out of the Bank of England, the US payrolls data on Friday, bullish for the dollar, bearish for sterling. So essentially you've got two factors basically pushing cable lower. It's expectations of Fed tapering in light of the improved US employment report on Friday, 195,000 new jobs added, the revision higher for the May number to 195,000 new jobs added. That's going to be perceived as very dollar positive, even though the Federal Reserve is still adding to the size of its balance sheet on a month-by-month basis. On the flip side of that, you had very disappointing manufacturing production and industrial production data from May earlier this morning. That data was horrible. And it really does surprise when you consider the very positive PMI data that we've seen throughout the most part of this year. So that is a little bit of a mystery, and does throw a little bit of a shroud over the Q2 GDP number that we could see coming out at the end of this month. It also feeds in to the or the likelihood of Mr. Carney and the Bank of England being less than supportive for the pound going forward. Now we can see from this daily chart, 148.30, the March lows. That's a key level on the daily chart. We bounced from there in March. We really need to hold above that level, and maybe 147.80, which I'm now going to show you on the weekly chart, which is just to the left of the 2010 lows, as being a key support area for further sterling, against further sterling declines. So we also have Mr. Bernanke talking tomorrow. We also have the latest FOMC minutes coming out tomorrow, Wednesday. So that could be actually a dollar negative factor depending on what comes out of that meeting. So not prepared to write the pound off yet, but we have to be aware that Mr. Bernanke could talk the dollar down. He could go cool on the tapering argument. We don't quite know. We also know that the pound remains very oversold, not only on the daily chart, but also on the much shorter term charts. So we really need to see a move back above 150.10, 150.20. Going forward, the broader picture for the pound still remains negative. If we look at this monthly chart, which I talked about in March this year, a massive consolidation process from the lows at 135, which we broke below in March. Now, if we take the target for that particular triangular breakout to its extremes, we can go potentially to 124 in cable in the next 2 or 3 years. We're not talking the next 2 or 3 months here, the next 2 or 3 years. And if the Fed does go down the tapering path and the Bank of England does get a bit more creative with respect to monetary policy, I certainly wouldn't rule a move like that out. We really need to get back above 158 to really diminish the risks of that happening. Okay, let's also talk about US 10-year Treasury yields and prices, because last week we broke below that 6-year uptrend from 2007 and the 200-week moving average. But we've only done it on the price. We actually haven't broken above it on the yield at the moment. So we are in a little bit of no man's land with respect to that. The high so far has been around about 2.73%. I would suggest the risk is for a move to 3% US yields. If that happens, expect to see further declines in US 10-year bond prices. Certainly with respect to the price chart, we've broken out, and I would expect to see further losses in US 10-year treasuries. Okay, so that's it for this week. Thanks very much for listening. Until next week, this is Michael Houston talking to you from CMC Markets.